stop. Do not sell your home yet, because one simple tax rule, one that most retirees have never even heard of, could decide whether you keep $250,000, $500,000, or lose it forever to the IRS. And here's the scary part. Thousands of retirees do everything right their whole lives, then make one small mistake when selling their home, and suddenly the government takes more money than they paid for their first house. This isn't a loophole. This isn't a rumor. This is a real IRS rule hidden in plain sight. And if you don't understand it before you sell, it's already too late. So stay with me till the end of this video, because what I'm about to explain could be the difference between a comfortable retirement and a tax nightmare you can't undo. Before we go any further, let me say this. This channel exists for you, not for Wall Street, not for politicians, not for clickbait headlines. This channel is for retirees, seniors, and families who just want clear, honest information without confusion, without hype, and without fear. If you're planning retirement, already retired, or helping your parents make these decisions, then this channel was created with you in mind. I break down Social Security, IRS rules, retirement taxes, Medicare, and home sales strategies in plain English, so you don't make expensive mistakes that most people never see coming. If you're getting ready to retire or already enjoying your retirement years, there's a crucial tax rule about selling your home that could save you hundreds of thousands of dollars. Yet, surprisingly, most retirees have no idea it even exists or how to properly use it to their advantage. This isn't some complicated loophole or questionable tax scheme. This is a legitimate benefit built right into the tax code by the Internal Revenue Service. But because so many people don't understand how it works or what mistakes to avoid, they end up paying enormous tax bills that they could have completely avoided with the right knowledge and planning. Let's start with the basics, because understanding this rule could literally be the difference between keeping $4 million or even $500,000 in your pocket versus handing it over to the government in taxes. When you sell your home, any profit you make is technically considered a capital gain, which means it's normally taxable income that you'd have to report to the IRS and pay taxes on. If you bought your home 30 years ago for $200,000 and you sell it today for $700,000, you've made a $500,000 profit, and without any special rules, you'd owe taxes on that entire gain. Now imagine how much tax that would be. If you're in a 20% capital gains tax bracket, that's $100,000 going straight to the government. And for many retirees, that's a devastating financial blow that can completely derail retirement plans. But here's where the magic happens, and this is what most retirees don't fully understand. The IRS has a special exclusion rule specifically for the sale of your primary residence, your main home where you actually live. If you're single, you can exclude up to $250,000 of profit from your taxable income completely tax-free. If you're married and filing your taxes jointly with your spouse, that exclusion doubles to $500,000. Think about what that means for a moment. If you're a married couple who bought your home decades ago and it's appreciated significantly in value, you could potentially walk away from the sale with $500,000 in profit and not owe a single penny of federal income tax on that money. That's not just a nice benefit. That's life-changing money that can fund years of comfortable retirement. However, and this is critically important, this exclusion doesn't just automatically apply to everyone who sells a home. There are specific requirements you must meet. And this is where so many retirees make costly mistakes simply because they don't know the rules or they misunderstand how they work. The IRS has what they call the eligibility test, and you need to pass this test to qualify for the full exclusion. The three main requirements are ownership, residence, and what's called the look-back period. And each one of these has nuances that can trip you up if you're not careful. First, let's talk about the ownership requirement. You need to have owned the home for at least 2 years out of the 5 years leading up to the sale date. Notice it says 2 years out of 5. Not that you had to own it for the entire 5-year period. This is actually more flexible than many people realize. You could have bought the home 3 years ago, lived there, and you'd qualify. The 2 years don't even have to be consecutive or recent. As long as you owned it for a total of 24 months sometime during that 5-year window before you sold it, you meet the ownership test. For married couples filing jointly, Only one spouse needs to meet this ownership requirement, which can be helpful in situations where one spouse owned the home before marriage. Now, we move to the residence requirement, and this is where things get a bit more strict and where many retirees accidentally disqualify themselves. You must have lived in the home as your primary residence for at least 2 years out of those same 5 years before the sale. Your primary residence means your main home, the place where you actually live most of the time, not a vacation home or rental property or investment property. The IRS looks at various factors to determine what your main home is, including where you receive your mail, where you're registered to vote, where your driver's license is issued, where you bank, and most importantly, where you actually spend most of your time. Unlike the ownership requirement, if you're married and filing jointly, both spouses need to meet this residence requirement individually to get the full $500,000 exclusion. If only one spouse meets it, you might only qualify for $250,000. The 2-year residence period also doesn't have to be continuous. You could have lived there for 18 months, moved away for a year, came back and lived there for another 6 months, and you'd still meet the requirement because you accumulated a total of 24 months of residence during that 5-year period. Even short absences like vacations count toward your residence time, which makes sense because you're not expected to never leave your home. There's also a special provision for people who become physically or mentally unable to care for themselves. If you lived in the home as your main residence for at least 12 months out of those 5 years, any time you spent living in a licensed care facility like a nursing home or assisted living counts toward your 2-year residence requirement. This is incredibly valuable for retirees who had to move to a care facility but still own their home and need to sell it. The third major requirement is the look-back rule, and this prevents people from repeatedly claiming the exclusion too frequently. You can only use this exclusion once every 2 years. If you sold another home and claimed the exclusion within the 2-year period before selling your current home, you don't qualify for the exclusion on the sale. The IRS put this rule in place to prevent people from flipping houses and claiming the tax-free treatment over and over again. For most retirees selling their long-term family home, this isn't usually an issue, but it's something to be aware of, especially if you've downsized once already in recent years and are considering another move. Now, here's something that shocks many retirees when they first learn about it. These exclusion amounts of $250,000 for individuals and $500,000 for married couples haven't changed since they were established way back in 1997. That's nearly 30 years ago. Think about how much home prices have increased since then, especially in certain markets. If these limits had been adjusted for inflation over the years, they would be somewhere around $660,000 for individuals and $1.32 million for married couples today. The fact that they've remained frozen at those 1997 levels means that more and more homeowners, especially retirees who've owned their homes for decades and seen tremendous appreciation, are finding themselves with gains that exceed these limits, and they're getting hit with substantial tax bills on the excess amount. This is particularly painful in high-cost areas like California, Massachusetts, parts of Colorado, New York, and other markets where home prices have tripled or even quadrupled over the past few decades. A couple who bought their home in the San Francisco Bay Area for $300,000 in the 1990s might be selling it now for $2 million. That's $1.7 million in gains. And after excluding the first $500,000, they still have $1.22 million in taxable gains, which at a 20% capital gains rate, plus the additional 3.8% net investment income tax that applies to high earners, could mean a tax bill exceeding $280,000. For retirees living on fixed incomes, that's absolutely crushing. This situation has created what financial experts are calling a lock-in effect. Many retirees feel trapped in their homes because they can't afford the tax consequences of selling, even though they might want to downsize, move closer to family, relocate to a lower cost area, or move into more accessible housing as they age. They're financially stuck, and it's affecting their quality of life and their retirement plans. Some lawmakers in Congress have recognized this problem and have proposed legislation to address it. There's a bill called the No Tax on Home Sales Act that would completely eliminate capital gains taxes on primary residence sales, and another called the More Homes on the Market Act that would double the current exclusion amounts to 500,000 for singles and 1 million for married couples. Whether these bills will pass remains to be seen, but they highlight just how outdated the current rules have become. Now, let's talk about some of the critical mistakes that retirees make with this home sale tax rule. Because even if you qualify for the exclusion, you can still lose out on significant tax savings if you don't handle things properly. One of the biggest mistakes is failing to properly document your home's cost basis. Your basis is essentially what you paid for the home, plus the cost of any substantial improvements you've made over the years. The difference between your basis and your selling price is your taxable gain. So the higher your basis, the lower your gain, and the less tax you potentially owe. Many retirees have lived in their homes for 30, 40, even 50 years. And they've made countless improvements, renovations, additions, and upgrades during that time, but they didn't keep good records. And now, when it's time to sell, they can't prove what they spent. Here's what counts as an improvement for tax purposes. Anything that adds value to your home, prolongs its life, or adapts it to new uses can be added to your basis. This includes things like adding a deck or patio, finishing a basement, installing a new roof, putting in new windows or doors, adding central air conditioning, remodeling a kitchen or bathroom, adding a fence, installing a security system, putting in new landscaping that enhances the property, adding a swimming pool, and many other substantial improvements. What doesn't count are ordinary repairs and maintenance like painting, fixing a leaky faucet, replacing a few shingles, or general upkeep. The distinction matters tremendously because if you spend $100,000 on improvements over the years but can't document it, that's $100,000 of additional gain you're paying taxes on unnecessarily. The smart approach is to start keeping detailed records right now if you haven't been. Keep receipts, invoices, contracts, before and after photos, permits, and any documentation showing what work was done and what it cost. Store these records somewhere safe and organized so that when the time comes to sell, you can easily calculate your adjusted basis and minimize your taxable gain. Even if you've already done improvements without keeping records, try to reconstruct what you can by contacting contractors you used, looking through old bank statements or credit card records, checking with your local building department for permit records, and documenting everything you can remember with written notes and dates. Another major mistake retirees make involves timing. The exclusion can be used once every 2 years. So, if you're planning to sell your current home and eventually sell another property, you need to think strategically about the timing to maximize your tax benefits. Some retirees sell their long-term family home, buy a smaller place, live there for a couple of years, then decide it's not quite right and want to move again, but they're still within that 2-year window from the first sale, so they can't claim the exclusion on the second sale. Proper planning and thinking through your housing trajectory for the next several years can help you avoid this trap. Also, consider the timing in relation to your income. If you're going to have taxable gain that exceeds the exclusion, it might make sense to time the sale for a year when your other income is lower, potentially keeping you in a lower capital gains tax bracket and avoiding additional Medicare premium surcharges that are based on your income. Here's something many retirees don't realize. If you've used part of your home for business purposes or rented out part of it, the rules become more complicated and you could lose part of your exclusion. If you had a home office and claimed depreciation deductions on your tax returns, or if you rented out a room or basement apartment, the portion of the home used for business or rental purposes may not qualify for the full exclusion, and you might have to recapture some of the depreciation you claimed, meaning you'll owe tax on it. This doesn't mean you shouldn't have a home office or shouldn't rent out space, but you need to understand the tax implications when it comes time to sell. There's also a concept called non-qualified use that trips up retirees. If you used your home for something other than your primary residence during the time you owned it, especially after 2008, the IRS might reduce your exclusion proportionally. For example, if you owned a home for 10 years, but only lived in it as your primary residence for 5 of those years because you rented it out or used it as a vacation home for the other 5, you might only get to exclude half of what you otherwise would. However, There are exceptions. Time spent living in the home before any non-qualified use doesn't count against you, and neither does any period of non-qualified use after you've already moved out and are trying to sell the property. This gets technical quickly, which is why consulting with a tax professional is so important if you've had any mixed use of your property. Let's talk about a mistake that can be particularly devastating for retirees, especially those dealing with the sale of a home after the death of a spouse. If you're a surviving spouse and you haven't remarried, you might be able to claim the full $500,000 exclusion, even if you're filing as single, but only if you sell the home within 2 years of your spouse's death. After that 2-year window closes, you're limited to the $250,000 exclusion. Many widows and widowers don't know about this time-sensitive rule, and they wait too long to sell, costing themselves up to $250,000 in additional exclusion they could have claimed. It's understandable that you might not want to make major housing decisions immediately after losing a spouse, but being aware of this rule can help you make more informed decisions during that difficult time. Another scenario that confuses retirees involves divorce. If you're divorced and your ex-spouse was allowed to continue living in the home you owned under the terms of your divorce agreement, you can count that time as meeting the residence requirement for yourself, even though you weren't actually living there. This is important because it means you might still qualify for the exclusion when the home is eventually sold, even if you've been living elsewhere. Similarly, if your home was transferred to you as part of a divorce settlement, you can count the time your ex-spouse owned the home toward your ownership requirement. These rules are designed to prevent people from being unfairly penalized by divorce situations, but you need to know they exist and how to apply them properly. Military service members, intelligence community employees, Peace Corps volunteers, and certain other government personnel get special treatment under these rules. If you fall into one of these categories and you're on qualified extended duty, you can suspend the 5-year test period for up to 10 years. This means you might be able to meet the 2-year residence requirement even if your service kept you away from your home for extended periods. This is a valuable benefit that many military retirees don't fully utilize because they simply don't know it exists. Here's a trap that catches some retirees. If you sell your home and then discover you have a large gain that exceeds the exclusion, you might think you can avoid or reduce the tax by immediately buying another home and rolling the gain into the new purchase. That rule used to exist years ago, but it was eliminated when the current exclusion rules were created back in 1997. There's no longer a rollover provision for personal residences. If you have a taxable gain, you have a taxable gain, regardless of whether you buy another home or not. However, there is a different strategy worth considering if you have substantial gains. If you hold the property until your death rather than selling it, your heirs will receive what's called a step-up in basis, meaning the property's basis is adjusted to its fair market value at the date of your death. If they then sell it shortly after inheriting it, they'll have little to no taxable gain. This is an estate planning strategy that makes sense for some retirees who don't need to sell their home during their lifetime and want to maximize what they leave to their children or other heirs. One more thing that surprises retirees is how the home sale can affect other aspects of your tax situation. If you sell your home and have a large gain, even if part or all of it is excluded from income tax, it can still affect your Medicare premiums if you're over 65. Medicare calculates your premiums based on your modified adjusted gross income from 2 years prior, and a large capital gain can push you into a higher income category, resulting in substantially higher Medicare Part B and Part D premiums for that year. This is called the Income-Related Monthly Adjustment Amount, or IRMA, and it can add hundreds of dollars per month to your Medicare costs. If you know you're going to have a large gain from a home sale, you need to budget for these potential Medicare surcharges that will hit you about 2 years later. So, what should you actually do with all this information? First, if you're planning to sell your home anytime in the next few years, start preparing now. Gather all your documentation about what you paid for the home originally, closing cost you paid when you bought it, and records of all substantial improvements you've made. Calculate roughly what your gain will be when you sell and determine whether you'll be under or over the exclusion limits. If you're going to be over, start exploring strategies to minimize the taxable portion, such as timing the sale for a lower income year, making additional improvements before selling, or consulting with a tax professional about more sophisticated strategies. Second, understand your timing. Make sure you'll meet the ownership and residence requirements before you sell. If you're close, but not quite there, it might be worth waiting a few more months to qualify. Conversely, if you're a surviving spouse approaching that 2-year deadline after your spouse's death, don't accidentally let it pass if you're planning to sell. Third, if you have any special circumstances like divorce, military service, business use of your home, rental income from your property, or any other complicating factors, don't try to navigate this alone. The potential tax savings from getting it right or the potential tax disaster from getting it wrong are too significant to guess or assume. Work with a qualified tax professional who understands these rules thoroughly. Fourth, keep in mind that tax laws can change. There are proposals in Congress right now that could significantly alter these rules, either by eliminating the tax entirely on primary residence sales or by substantially increasing the exclusion amounts. Stay informed about potential changes because they could affect your decision about when to sell. Finally, remember that while tax considerations are important, they shouldn't be the only factor in your housing decisions during retirement. Your quality of life, proximity to family and healthcare, the suitability of your home for aging in place, your ability to maintain the property, and your overall happiness and comfort matter enormously. Sometimes paying some capital gains tax is worth it if it means moving to a living situation that better serves your needs and goals for your retirement years. The home sale capital gains exclusion is one of the most valuable tax benefits available to homeowners. And for retirees who've built up substantial equity in their homes over decades, understanding and properly using this rule can mean the difference between a comfortable, financially secure retirement and struggling with unexpected tax bills. Take the time to learn the rules, keep good records, plan your timing carefully, and seek professional guidance when needed. And you'll be in the best position to make smart decisions about your home and your retirement future.